U.S. inflation rises due to Trump's tariffs. The Federal Reserve's preferred inflation measure, the Personal Consumption Expenditures (PCE), ticked higher last month, signaling that President Trump's tariffs are pushing some prices up. Prices rose 2.6% in June compared to a year ago, according to the Commerce Department, up from 2.4% in May. Excluding volatile food and energy categories, prices rose 2.8% over the past year, matching the prior month's increase. This data supports the central bank's decision to keep its key interest rate unchanged, citing elevated uncertainty about the impact of Trump's new import duties. Federal Reserve Chairman Jerome Powell emphasized that inflation remains above the 2% annual target, noting that it may take months to determine whether tariff changes will lead to just a one-time rise in prices or a more persistent increase. Scott Helfstein, head of investment strategy at Global X, highlighted that while inflation data shows some evidence of tariff effects, it remains modest, with healthcare, housing, and utilities still playing key roles in driving inflation. On a monthly basis, prices rose 0.3% from May to June, while core prices also increased 0.3%. Both figures exceed the 2% target. Wednesday's decision to leave interest rates unchanged was cited as a response to concerns over the economy's outlook and inflation exceeding its 2% goal. The central bank last cut rates in December 2024, before Mr. Trump's January inauguration. However, the majority of the Fed's 12-person FOMC voted to maintain rates at 4.25 to 4.5%, though 2 members opposed a reduction. The rise in the PCE inflation index may reduce the likelihood of a rate cut at the September meeting, as confirmed by Harry Chambers, an assistant economist at Capital Economics. Core prices in June rose significantly, including upward revisions to previous month's data and sharp increases in core goods inflation, which would do little to ease concerns about tariff-driven inflation, he said. Higher grocery and gas prices jumped 0.9% from May to June, while furniture and appliances saw clear price increases. Service costs fell dramatically, offsetting some of the price pressures from goods. Airfares dropped 0.7%, and hotel room costs plummeted 3.6%. Consumer spending rose 0.3% from May to June, a small gain adjusted for inflation. Incomes increased 0.3% last month, reflecting a rebound after a 0.4% drop in May. Adjusted for inflation and taxes, incomes remained flat in June. Consumers have been cautious throughout the year, as noted by the government. The second quarter GDP growth in June reached 3%, indicating economic expansion. Though this highlights potential challenges. Consumer spending, for example, rose at a slow 1.4% pace, following a smaller gain in the first 3 months of the year. A sharp decline in imports in April-June helped strengthen the government's projection of U.S. GDP. Earlier this month, the government reported that the closely watched CPI also rose in June, reflecting rising costs for imported items such as appliances, furniture, and toys. U.S. inflation heats up in June. Tariffs boost goods prices. Fed policy impact. Inflation in the United States is heating up faster than many anticipated, and the culprit? A surge in tariffs that's quietly reshaping the cost of everyday goods. But here's where it gets tricky. While some economists see this as a temporary blip, others argue it signals a deeper shift in how global trade policies are fueling price pressures. And this is the part most people miss. Tariffs aren't just affecting imported furniture or recreational gear. They're sending ripples through the entire economy, from consumer wallets to the Federal Reserve's next move. Let's dive into the details. The Commerce Department's latest report reveals a 0.3% rise in the Personal Consumption Expenditures (PCE) price index for June, marking a sharp turnaround from May's revised 0.2% gain. That might not sound like much, but it's the largest monthly jump since January. Goods prices, in particular, spiked by their most significant margin in over a year, with household furnishings and recreation products leading the charge. Think about it. The chair you bought last month might now cost 1.3% more than it did in May. That's no small change when you're budgeting for home upgrades or a new bike. Core PCE inflation, which strips out volatile food and energy costs, also climbed 0.3%, pushing the year-on-year rate to 2.8%. Meanwhile, consumer spending edged up 0.3%, held steady by a 4.5% savings rate. But don't be fooled by the numbers. Behind the scenes, the labor market is showing signs of strain. Initial jobless claims rose to 218,000 for the week ending July 26th, a 1,000 increase from the prior week. Employers, wary of where tariffs will settle, are holding back on hiring, leaving job seekers in a tough spot. The Federal Reserve, which keeps a close eye on the PCE index for policy decisions, left interest rates unchanged at 4.25 to 4.50% in July. Chair Jerome Powell's post-meeting comments even dampened expectations for a September rate cut, a move that had been widely anticipated. Olu Sonola of Fitch Ratings summed it up bluntly. Inflation is now clearly diverging from the Fed's target, and this trajectory could delay rate cuts until at least October. But is that really the case? Could tighter monetary policy have already done enough to curb price growth? Or are tariffs creating a new kind of inflationary pressure the Fed isn't prepared for? Take Procter Gamble, for instance. The consumer goods giant announced this week it would raise U.S. prices to offset tariff costs, a decision that could trickle down to other companies. If more firms follow suit, we might see a broad-based inflation surge in the second half of the year. And here's the kicker. Even energy prices, which had been falling for months, rebounded 0.9% in June. Services inflation, meanwhile, remains in check thanks to cheaper airfares and stable hotel costs. But don't count on that lasting forever. Consumer spending, which drives over 2/3 of the economy, held steady in June, after a flat May. But the real story lies in the income gap. Lower and middle-income households are feeling the pinch of higher prices and slower wage growth, while wealthier families continue to spend. Gregory Dacko of EY Parthenon warns consumer spending now faces mounting headwinds from a cooling labor market and renewed inflationary pressures. So where does this leave us? The Fed is caught in a tightrope walk. Cut rates too soon and risk fueling more inflation. Wait too long and stifle economic growth. As the government prepares to release its July jobs report, economists are bracing for an unemployment rate that could rise to 4.2%. But here's the question we need to ask. Are tariffs the real driver of inflation, or are they just a symptom of a larger, more complex global economic shift? Share your thoughts in the comments. Do you think the Fed will finally cut rates in October, or is this just the beginning of a longer, hotter inflationary phase?